Welcome to Get Rich Education. I'm your host, Keith Weinhold. Depending on your age and goals for income and net worth from real estate, you need to avoid getting trapped in both the past and the future. Whether you're in your 20s, 30s, 40s, or 70s, how do you really find investing clarity and strategy? Often it's about keeping it simple on the way to reaching your goals as an investor within your own chosen niche. Today on Get Rich Education. Congress just made it possible to get up to $100,000 out of your current 401k or TSP to invest in real estate, gold, or even your own business. That's even if you're still working, and avoid the IRA UBIT tax. The thing is, you can get your money tax and penalty free for a limited time. The EQRP is your secret weapon. With the CARES Act expiring soon, the EQRP company helps you unleash your retirement funds now. Learn more and text message EQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Here it is. Hey, welcome to Get Rich Education. I'm your host, Keith Weinhold. Let's talk about time. Now, in your life, you've probably known some people that seem to be trapped in the past. It might be that they're heartbroken over a relationship gone bad, or a deal gone bad, or maybe the only music that they listen to is from 1990, and that person seems to be trapped in the past. Now, I like some throwback tracks sometimes, but realize that listening to music from 1990 is like people in 1990 listening to music from 1960, and you might want to stay more current along with your throwbacks. Well, I recently heard a great quote about getting trapped into living outside of your own present reality, and that is, getting trapped in the future is as bad as getting trapped in the past. You cannot change the past. The only way to change the future is what you are doing today. Yeah, that right there says so much about the importance of being an action taker. As much as I wish I would have thought of that quote myself, that is from Michael Ayala. Check out his platform. It's called Investing for Freedom. But yeah, I've got some friends right now that seem to be trapped in the future. They think that the future is always going to change, or maybe they just think that the future is totally out of their control, so therefore they're frozen within action instead of making the decisions today that will positively change their own future tomorrow. Now, when you're younger or when you just get started in real estate, a low property price can be the most important thing to you because you often have less money. That cash flow means more to you at that time in your life as well. That makes it more likely then that you'll start with existing rehabbed property. When you're older, that tilts a bit more toward you wanting new construction property in your portfolio. New builds generally cost more, but it's okay because you have more money at this later time in your life, and the cash flow can be pretty low here. But that's less important to you because you're more likely to earn more at your job when you're older. They are the cash flow trade-offs. And then real estate investors have that benefit of long-term appreciation too. Speaking of the future and appreciation, did you know that I have been underestimating real estate's appreciation rate for years now? Yeah, it's generally appreciated at 3 to 4% in recent years past. And I was saying back then that I didn't really see what would make real estate appreciate more than that near term, but recent events sure have made the appreciation rate of real estate higher than 3 to 4%, namely a pandemic and riots, along with low inventory and low interest rates. And it really just goes to show you that you cannot time the market. But now, no matter what time of your life you're in, your 20s, 30s, 40s, 50s, 60s, or 70s, you need to get clear on the outcome that you want. When you begin with the end in mind and then track your way back to what you need to do today, then you will avoid getting trapped in the future. So let's get some background and then talk about it with this week's remarkable guest. I'd like to welcome an exceptional investor onto the show today. He is thriving inside a pretty durable and profitable real estate investment niche that we're going to discuss. And I've been investing my own money alongside him for 2 years now. And his business partner and wife were actually wonderful hosts for our Get Rich Education Tampa real estate field trip exactly 1 year ago at this time. David Shaw, welcome to Get Rich Education.
Thank you very much, Keith. It's a real pleasure to be on your show.
Tell us a bit about yourself and your real estate background.
Keith, like most people, I didn't qualify in real estate investing in university. Very few people leave university with a degree in real estate investing. Right. So we've all made our way here in various ways. So for me, it was a little bit more direct. After university, I was a construction project manager for many years. And whilst I was doing that in San Francisco, in New York, and in Dublin, in Ireland. I am Irish, you can see that. During that period, I had some ad hoc investments in the late 90s, early 2000s. And it was in 2004 and 2005, as I was starting to sell some of those. I had no real plan as to why I was selling them. It's just, doing a little bit of profit taking. It's in that time when I realized, real estate investing is fairly passive and can be exceptionally profitable. So how do I scale this thing up, or how do I take this more seriously? I did my real estate investing, and in like 2003, 2004, that bug was really at me. So I decided to pack up my project management in totality, put myself to real estate investing full time. And how I went about that was I wanted to learn the business before I actually just start getting into it personally. So I worked for a couple of real estate investment companies, some emerging market companies. And in that, I met my previous business partner, Colin Murphy. And from there on in, I took to the world of real estate investing and working with investors full time. So, Keith, I've been working with out of state and overseas investors since 2008 full time. So I guess that puts me in the business full time, 12 years. And I hope that clears up a little bit about my background.
You've now bought and renovated almost 500 houses around Tampa. That's the niche that you found. It's an area where the numbers really work. What does your observed ideal investment house look like then that you buy for your own personal portfolio? And now, more recently, you deal with new build homes as well. So tell us about that niche.
It's great. I believe identifying what your niche is early on in your investment career is exceptionally important. Find something that works. It should be boring. It should be something that's quite simplistic. It should be something that you're able to fully understand. You understand the deal. You understand the neighborhood. And once you have a small, whittled down set of criteria, repeat. The investors that I have seen throughout my career who are most successful, and I'm talking about the rehabbers, the flippers, they're the people who have a very narrow band of what they do. They're not working in 20 markets with 20 different types of properties. So for me, when I look at my market, I see the real estate market in a lot of US cities, almost like geological layers. In the inner core city, you got the downtown, but then out to that immediate outside downtown tends to be these frame homes built in the 20s. Those homes, they tend to be gorgeous, leafy, red brick neighborhoods, but they're quite difficult to buy. They're quite difficult to renovate. They're older homes. They have settlement issues. So I don't invest, albeit that these are great neighborhoods. I don't invest in those neighborhoods. I also don't invest in 1950s. So they didn't build much in the 30s and 40s, but they started to build again in the 50s and 60s. I tend to stay away, if I can, from a 1950s and 60s home because I'm going to start running into cloth wiring, asbestos, lead paint, just things that I can avoid. So for me, the sweet spot in the Tampa Bay area is these smaller mid-1970s, early 1980s concrete block homes. They're basically up to date in most respects. They don't have cast iron piping. They don't have cloth wiring. They have PVC piping. They don't have asbestos. They're that little, almost like Goldilocks porridge property. They're very easy to buy. They're very easy to renovate. It's just doors, floors, baseboards, a simple AC, a simple roof. It's almost largely a cosmetic renovation. Very easy. There's no exterior issues with siding or termite damage. So for me, the perfect property is a mid-1970s concrete block home. If you can find those neighborhoods and then just repeat, I found that to be a beautiful little niche for me in the Tampa Bay area.
Yeah, now not every MSA, Metropolitan Statistical Area, has an investor advantaged area or box within it, but West Florida there and the Tampa MSA in the nearby environs sure do. I like how you have often described it as a buy box. You have this very defined criteria in a buy box, and that thought of a box, I think, really helps delineate it and really show why you are choosy about where you buy.
Keith, so you are right. The investors that I see that are more likely to fail than not are the investors who have what I call shiny object syndrome. So people, they might be looking at a 5-unit one day, a 7-unit the next, a single family, a mobile home the day after. Those investors tend to be jack of all trades and master of none. So for me, in terms of my buy box, so I'm 48 years of age. I've been doing this a long time now. And I think the key in real estate is to not have to be learning new things all the time. I'm like a dog that doesn't want to learn any new tricks. Tricks in real estate cost money. Lessons, each time you step outside your box, you're invariably going to put a foot wrong. So for me, I found success in identifying 1 to 2 little strategies that work well, build on those strategies, build on them because you know them intricately. There's nothing I don't know. There's no scenario I haven't seen and understand. So for me, it's just essentially important to understand that real estate at its core is about scale and simplicity. If any deal that you're doing is not something you feel you can scale and is more complicated than you understand, you shouldn't be doing it. You should be looking for a different methodology of investing.
You're the leader of your business there. And David, you spend so much time talking one-on-one with people from out of the area that want to invest in that area. In fact, I was one of those people. I was one of those investors that talked with you at one time and got interested in buying in your area there. So basically, you get to canvas a really big investor section. You do a lot of these calls remotely. I know at times in the past when you're out on the West Coast, you'll meet in a California hotel one-on-one with interested investors that have questions. And you've really delineated a few strengths, 4 clear strengths that make a real estate investor successful with this great survey size that you have.
What separates successful investors from non-successful investors is 4 very simple things. Number 1, this real estate investing is not so much about the house or about the market. Real estate investing is about you. It's about your needs, what you need. If you were to give up your job today or tomorrow, what would you need to live on? What would you need in terms of your cash flow? What would you need in terms of your overall net worth?
That's right. The property is just the conduit. So this is beginning with the end in mind. What do you really want out of these properties?
Yeah, you would never start a marathon without knowing where the end of the marathon was.
Right.
Okay, so it's just a simple analogy. But it's incredible to me, Keith, how many people come to the table and they're like, yeah, like I'll buy one and I'll see how it goes. If it works out, I'll buy another. Those people invariably fail. In addition to that, Keith, what I also find is people who they come to the table and they got a great deal in a fantastic neighborhood once. They can't repeat it twice. They can't repeat it 3 times. So what I'm saying is you need to come to the table with a clear income and net worth goal. If you come to the table and say, I need $15,000 a month in net income and I need $3 million in net worth, from there, once you understand what your income and net worth goals are, you can then start to actually quantify what it is that you need. I'll give you an example. So let's say you wanted $15,000 in gross income and $2 million worth of net worth. And he wanted it from real estate.
And this is $15,000 of gross monthly income.
Yep. And $2 million of net worth. Well, the bottom line is that you're going to utilize mortgages. I'm not going to talk to your listeners about how to use mortgages, but the bottom line is in approximately 20 years, that $15,000 of gross income, because of inflation and because of compounded inflation, you're going to need about $30,000 in gross income in 20 years. I checked some CPI data and it's about 100% every 20 years. If the same is true for your net worth goals, $2 million, you're going to need $4 million. So the bottom line is if you wanted to understand what you're going to need in 20 years' time, ask yourself what you need today and then start preparing for what that might look like. So $15,000 in gross income, in my world, let's say $200,000 homes, that's that rent for $1,650, you're going to need about 10 of them. And in terms of what would 10 homes in my world look like at $200,000, be about $2 million worth of real estate. That's how to set out your clear income and net worth goal. $15,000, basically 10 homes will do that. $2 million of net worth, basically 10 homes will do that. So if you now know how to quantify what you need, it throws out this idea of, oh, I'll buy one house, or I'll buy a cheap house in choose your market, or I'll buy, an older house with a very high net yield. They did a very fine balance between getting your income and your net worth goals working in tandem together. So the successful investors start off with a clear income and a net worth goal, Keith.
And I'm glad you put those numbers out there, whether that's this particular listener's numbers or not. That helps give one a clear vision, a beginning with the end in mind.
That's right. And it also gives people a clearer vision of, well, this isn't about me buying one or two. If I want to retire in 15 years or 20 years off the back of leveraged real estate, I actually need to buy 10. It's the time and the mortgage and the tenants that's going to do the work. But in order to plant those oak trees of my retirement now, I need to plant 10 seeds today. So it gets people, when I have this conversation and we break it up, it allows people to understand this isn't about buying one or two houses, or this isn't about getting a great deal in a good neighborhood. This isn't about one off this or one off that. It's about actually setting up an overall clear income and net worth goal. It's one thing to set up the goal, but then you need a defined strategy to execute the goal. So what does that mean? We can often be our own worst enemy. Oh, I was busy, or oh, I got this, or oh, I got that. No, the defined strategy is the best way I can put it to you is imagine you are setting up, in addition to your work or whatever you do in your life, you're setting up a startup on the side of you're bolting a startup business onto the side of your life. You're going to treat that like a business. It's going to have ups. It's going to have downs. It's going to be hard. There's times it's not going to be easy. But if you treat this, you start off with a goal, and then you treat this like a business with a defined strategy and with the resilience to get that strategy going, that's now we've planted the seeds. So it's very important to have this defined strategy about implementing your goal. But then this is a 20-year thing in my view. The defined strategy is also includes treat it like a business. Create a defined real estate account. Do not let any of your personal money commingle, or your rents or anything like that commingle with your personal affairs. Believe me, I own a lot of real estate. And if you have all of your real estate over in a certain account and all of your rental income goes into that account, I don't use rental income for my current day-to-day living. So all of my income is always building up in my real estate accounts. If somebody calls me, Pete, and they say, hey, listen, we need a roof over here, we need an AC over there, our tenant's leaving, or Lord forbid, we have a vacancy or an eviction. It's exceptionally rare, by the way. But I don't care. I'm like, okay, well, the money's there. That's what it's for. That's what the rainy day fund is for. So it's not emotional.
Right.
So,
and that's part of the discipline, that stick-to-itiveness of this long-term strategy.
Yeah, and that's it. The discipline is about putting all the money into a separate place. You're not getting it till your retirement. You're going to use this money to build up your inventory, and then you're going to use this as your rents rise. Let's say your rents are $1,500 today, and they're $1,800 in 5 years' time, and they're $1,200 in 7 years' time. What you're going to do is you're going to take all of that extra rental income and pay down your 10 homes so you can retire sooner, rich with real estate. But most importantly, Keith, and you and I share this, I don't quite have it tattooed on my chest yet, but I might. You need a time to do it. There is no point in coming to the table when you're 75 with a 20-year plan. That's just not going to work, unfortunately. And I don't want to disparage 75-year-olds, but it's harder to implement a 20-year plan. I want to emphasize to your listeners, start as early as you can, identify your goal, scale, and let time, inflation, and your tenants do all the hard work.
Oh, that's very well said. Yes, this is get rich education. It's not get rich quick. So there is that addition of time. And some wonders, well, what is the point of acquiring wealth if it takes a little while? Well, most people never acquire wealth at all. That's the point. And I'm sure you, the listener, can tell that David really is used to sitting down face to face or maybe doing it over Zoom and talking with people and helping them customize their strategy to really build a plan to not just buy a one-off property and see how it goes, because that usually doesn't turn into very much. And that person probably isn't working within a well-defined strategy. David and I are going to come back and talk about what hinders investors and what can make them get unstuck. You're listening to Get Rich Education. I'm your host, Keith Weinhold. Most rental property investors choose either positive cash flow or home price appreciation, but one real estate market can provide both. Jacksonville, Florida. With 9% lower home prices than the national median, 1% higher gross rents, and Jacksonville has appreciated 34% more than other comparable cash flow markets since 1991. Get positive cash flow today and appreciation for tomorrow. To invest for cash flow and growth in Jacksonville, go to cashflowandgrowth.com. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to fourplexes. They're the #1 lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
This is Rich Dad Advisor Ken McElroy. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with David about income property investing today, especially the Investor Advantage single-family homes in Western Florida. David, a lot of times people need to get unstuck, investors get hindered. I think one problem that seeps in for investors over time is this concept of timing the market. People try to time the market. And I think it's part of that whole buy low and sell high mindset that comes from a more elementary investor notion that is usually been steeped in the stock and mutual fund world. But as I'm quick to remind people, real estate pays you up to 5 ways at the same time. So it's really not a buy low and sell high sort of endeavor. So what do you see in canvassing and surveying all these investors over time as some of the traits that hinder investors from reaching their true potential?
It's a great question. It really is. This is some of the most important stuff in real estate, in my view. First and foremost, Keith, I think the foundation of real estate investing is quite simple. And we have a tendency as human beings to overcomplicate it. And what my first piece of advice to most people is keep it simple, get out of your own way, allow it to flow, allow it to grow. And from there, your worst case scenario, I deal with investors all day long, and they have put every single barrier, mental barrier, and worst case scenario in front of them. Believe me, after I've traded right through the last downturn, I've been investing personally for over 20 years. And I've, as you know, renovated over 500 homes, and I continue to renovate. I have never experienced a worst case scenario. I've never had a rental that didn't rent. I have in all of the homes that I've ever bought, and I'm buying homes sight unseen. I'm not buying on the MLS. I'm buying homes sight unseen in the foreclosure auctions. And even still, I have never experienced what most people come to me as being a worst case scenario. So do not overcomplicate it.
That worst case scenario only happens in your mind.
Don't overcomplicate it. Get out of your own way. Now, secondly, understand the power of importance of time, right? The power and importance of time. Start as early as possible, Keith. Many of my investors, this is an observation that I could make all day, every day. Most of my investors come to me between the ages of 42 and 48. And they have, by and large, I'm not saying them all, I'm not talking to all your investors, I'm just saying this is the biggest block.
Yeah.
Between 42 and 48. And where they are is they realize that these are highly paid professionals. They realized in their 20s and 30s, they thought they were doing fantastic. But then they had wives, kids, they're earning 200,000, then they're earning 300,000. In your 20s, that's fantastic. In your 30s, that's fantastic. But by the time you start reaching your 40s and you live in California, you live in an expensive MSA, you have a house, you have a mortgage, you've got kids education, healthcare, all the other costs associated with running a family, 2 cars, everything that at the end of the day, they pay their taxes on their W-2 income. And at the end of the day, they realize they can only save maybe $60,000 or $70,000 a year. And then they might go into a 401k, some kind of conservative 401k. And something hits most of my investors somewhere between the ages of 42 and 45. And it's like, this $500,000 or $600,000, it's not enough. And what's happening is, and the reason why it hits you at 42 to 48 is you realize that the young guys in your office, they can work longer hours than you. They're cheaper than you. They know all of the latest lingo and they know all of the latest coding and engineering technologies that are out there. You have to leave the office at 5:30 every day because you've got a wife and kids. You can't work the weekends.
Yeah.
You start to burn out a little bit. And then ageism is starting to creep in, especially in the tech world and various other industries.
Right.
And they start realizing in their mid-40s, they're like, if I wanted to retire tomorrow, next year, the year after, this $600,000 or $700,000 is not enough. Understanding the importance of time with real estate investing as early as you can in your life. So if you're in your 20s, if you're in your 20s and you're listening to this, know that the time that you have in your life right now in terms of investing is the biggest asset that you have. If you're in your 30s, get going now. You can retire by the time you're 50. If you're in your 40s, you have no time to waste. If you're in your 50s, you really need to get going. But the power of time, Keith, is just essential. Understanding what real estate investing does, it does it over time. I want to know a very interesting just experiment we can all do at home is get an amortization schedule up on Google and just put in 20 years at 4%, $200,000 mortgage. And it's amazing to see it. The first few years, the bank has taken all their profits off your 30-year fix. But by year 10 and 15, that your amortization schedule is paying you up to $1,000 a month. So your tenant is making you wealthy by $1,000 in addition to your cash flow, which might be $1,000 on year 10. By year 10, if you have 10 or 20 single family homes, just on amortization payments, basically equity creation, you could be getting more wealthy by $20,000 or $30,000 a month. Go look at an amortization schedule and then tell me the importance of time. So coming to real estate investing late in life, start as early as you can, get serious, scale, get meaningfully big, and you can change the course of your life. Of course, it's never too late. But the earlier you start, the better your return will be over time, and possibly the earlier you're going to be able to retire.
And importantly, that effective leverage really kicks in and shows itself with 10 or more years of investing.
That's exactly right. But I also find one of the areas where people are not reaching their true potential, they're coming and they're reasonably well-paid guys or girls, and they come to the table and they're chasing high cash flow. They don't necessarily need high cash flow. They don't need that extra income in their lives today, but they seem preconditioned to going for surely an 11% return is better than a 6% return. Well, it's not how I see it at all. I go for quality. I go for larger mortgages. If I'm going to take 10 or 20 mortgages, I want them to be $200,000 mortgages and not $75,000 mortgages. So definitely chasing low price, high cash flow, high yield properties, in my view and my experience, tends to be fool's gold and can often lead to disappointment in my actual experience, my personal experience. Why do people fail to reach their true potential? I'm going to run the gamut. Fear of failure. They heard a horror story from a friend, so they don't want to do it. They're trying to time the market, panicking about worst case scenarios, analysis paralysis. In my view, just stop overthinking it and take action. Because I've often said, when we buy real estate, we look a little bit like fools because we're putting 40 grand down. Most people understand it. We're going to make 350 or 400 a month off it. Doesn't look like a great deal. But actually, the day we buy real estate, we look like fools. 20 years later, we all look like geniuses. That's it. Get out of your own way. Don't be trying to time the market. Start early. And believe me, your worst case scenario, your fear of failure, or that horrible horror story that your friend has, none of this stuff matters. Just get in front of it and do it.
Yeah, horror stories are an interesting thing. And when that highly paid professional has an occasional problem with the property, they seem to inflate the problem that is relative to problems that they have at work, which are just expected. And any problem that you have at work, that's a problem that you have inside a vehicle where as soon as things go well again at work, that income isn't passive. It wasn't passive at either time. But with property, when things are going well again, which is the norm, that is passive. And your workaday job doesn't have the capacity to be passive at all. So it's just kind of funny how people compare their problems with the property, which only happens occasionally, with problems that happen at work, which is quite frequent. So, David, one trend that we've seen in real estate, and especially the turnkey market in the past 10 years or so, is more and more of this new construction that's been available to investors versus only renovated property. And I know that you deal in both there in West Florida. So can you compare and contrast the two, rehabbed property versus new build, which is what you're doing more of lately?
I'd love to, Keith. Thank you. I love rehab properties. I love the neighborhoods, the little buy box that I work in, and I will continue to work there for my remaining days as an investor. But there's also, in the last number of years, basically the last 2 to possibly 3 years, there's a little bit of a drift towards new build homes. What's initiated that drift is a bit of yield compression in existing homes. As obviously what yield compression is, for those of you who don't understand, it's as prices rise, yields fall. So that's true of most assets. So there's a little bit of yield compression. You know, we're not getting those 8 and 9% returns on the rehabs anymore. We're kind of down to high 6s and mid 7s. So increasing rehab prices. So overall, the existing home space has seen a lot of appreciation. There's lower inventory. So there's a lot of people chasing these existing homes. And so the gap between rehabbed homes and new homes is narrowing. Existing rehabbed homes tends to be somewhat urban. They're in the city, they're closer to the big MSAs. By and large, it's true to say that a lot of the new built home are on the new suburbs. So it's important to understand that, the locations of new and existing are always going to be different. I think existing homes will always be closer to that inner core. But the big reason why the new build product exists at all now is that builders and lenders basically totally ignored the lower end of the market since 2010.
Right.
Entirely. They just turned a blind eye to it. If you didn't have a FICO score of 750 in Florida, you just weren't buying a new home. So the builders were not building that 160 to 170, 180 single family home. They were building 350 and above single family homes. And that was where the lenders were. So basically, you need the builders and the lenders to be in the same place. As the demand has increased more and more and more for this kind of sub 250 home, finally, builders and lenders have aligned. So this new build product, this sub 250 new build product, is now giving a rehab home a run for its money. The yields still on a rehab property might be slightly bigger. We're talking maybe half a percentage point. The prices of my rehab homes are still a little bit lower. My rehab homes run from, let's say, 130 to 170, whereas my new build homes, they come in at 190 to 230, but they garner more rent. I think my new build homes are typically, I'll give you some examples. It's about $190,000 for a 1,300 square foot home, throws off about $1,500 a month in rental. And the net yield, obviously property management, insurance, and all those other costs, my net yield on that $190,000 home is 6.81%. I also have an upgraded single family home. It's 1,450 square feet, granite vaulted ceilings, poured exterior pad, all of that. Gorgeous home. You would live in it. That's at $220,000 to $230,000. It's 1,450 square feet. It's about $1,650, $1,675 in rent. And that throws off approximately a 6.5% net yield. In terms of returns, these newer homes, they have less maintenance by and large. They come with 1 to 2 year bumper to bumper warranties. Everybody likes a new build home. Buyers like it, owner occupiers like it, and believe me, renters like it. They cost a little bit more money, but they rent for a little bit more, and they tend to have dramatically less maintenance. If you buy a 80-year-old home that's been lipstick, paint and carpets type renovation, that 80-year-old home is going to give you fairly consistent and constant maintenance issues over a 20-year period. In my view, if you want to scale and get big and buy 5 or 10 homes and hold them for 20 years, a new build product will by and large basically serve that need. And it's easier to buy them. There's more of them. And it's easier to scale with a new build home. By and large, they're easier to manage.
That's right. With a new construction home, your yield isn't going to be quite as high as it is with a rehabbed home. This might work better if you're a busy professional with your new construction home, because you're not going to be hearing from the property manager very often because there won't be as much taking place. And if you would like to self-manage, some people choose to self-manage remotely. That's going to be easier in general on a new construction property than it is with a rehabbed home, because you're going to be able to retain tenants longer typically in that new construction property as well. David, do you have any last pieces of advice or guidance for our audience here?
I do. Over the years, I have, as a guy who's bought and renovated and flipped hundreds and hundreds of homes, and I've done over 1,000 real estate deals, I would like to impart some final thinking on what this conversation has basically been about. And it's been personal for me. I have earned a lot of money. And what I end in my career and what I've done, that I didn't pay enough attention to building up a large portfolio. I spent more of my time rehabbing, flipping, trying to become the biggest flipper I could become and really get, 100 doors out a year or 80, 90 doors out a year. And that was my focus. I have one regret in my investing career, and that's not keeping and holding more. I realized this: you can earn a lot of money, but you will pay a lot of taxes. And in life, the clearest path to wealth creation is to do so in a meaningful way. Buy, hold, don't create tax events. That's why Warren Buffett doesn't pay any taxes, because he doesn't sell. He buys and he doesn't sell. So find a way to invest as early as you can. Find a way to get big enough as early as you can, and realize that you cannot earn your way unless you're scalable. You own a business that's scalable. It is very hard to outrun inflation with a salary. No matter how much you earn, it's very hard. There's a few of us who do it, but most of us don't. You cannot get wealthy earning alone. You have to be investing in a scaled fashion to actually create meaningful wealth for you, your family, and your children.
That's right. Most salary earners in the United States invest their dollar, and they're only getting their own money to work for them. Now with real estate, we're talking about a vehicle where you can get other people's money to work for you. The banks for the leverage, the tenants for the income, and the governments. And yeah, when you talk to most long-term real estate investors, sure enough, David, if you ask them what their biggest regrets are, they typically say the same two things. I wish I would have bought more, and I wish I would have bought sooner. Flippers have spending money, but buy and hold investors create real wealth. And over my career, I've often talked to flippers that want to get into the buy and hold game, but rarely, if ever, do I hear anyone that's doing the buy and hold game well that wants to get into flipping. It usually just doesn't go the other way. Well, that's David, right. You've really helped give this great, I think, vision and strategy for investors and how you help them there. You can do that with this durable asset and product type in a thriving MSA at GetRichEducation.com/West Florida. David has put a report there for you so that you can learn more about the product at GetRichEducation.com/West Florida, offering both rehabilitated homes, typically 70s built, and new construction built. So therefore, they do have available inventory now. David, it's been great having you here on the show.
It's been my pleasure, Keith. An honor. Thank you so much.
Oh, yeah. Terrific material with David today. I like the emphasis on simplicity. At its core, what you do should be simple. In fact, if you have, say, a coworker that invested primarily in stocks and mutual funds, and it was time for you to retire before they could, and they came and asked you how you did it, you can answer as simply as saying, I rent houses to people. That was what, 5 words? At its core, that's all you're doing. I really like that our guest today describes something else with the time element. When you're a direct owner of real estate, you do get all the best return on investment benefits that way, but it shouldn't be 100% passive, just usually passive. He discussed why it's like bolting a startup business onto the side of your life, and real estate investing should be like bolting a pretty low-touch startup business onto the side of your life. So here with David, he's got the market, the product, and the property management solutions for you all in one here. But he and her name is Apple and others on his team are really great at helping you build that vision for yourself, saying, here's the income and net worth that you would need to replace your day job income or to get you financially free at, say, age 55 instead of 65. And now that we know the future income that you need, here's the inflation adjustment for your future, and then work your way back to today. Their renovated properties are about 45 minutes north of Tampa, St. Petersburg, Florida. Their new build homes are infill properties, and they are south of Tampa, St. Pete in a busy growth corridor close to Interstate 75, which makes them so attractive to tenants. We're talking about affluent and booming Sarasota County with the new build suburban areas like Northport, which is about 45 minutes south of Tampa, St. Pete, and then further south in Port Charlotte and the Fort Myers Cape Coral area. Prices on the new construction range from $190,000 to $235,000. Prices on the rehabbed homes are substantially lower than this. The rehabbed homes do have a little better rent-to-price ratios. And again, the rehab ones are north of Tampa Bay. The new construction is south of Tampa Bay. This is really one of those more actionable episodes here. So if you're pre-qualified or using all cash, get the report at getricheducation.com/West Florida. You'll get David's contact information, see about the strong construction quality of the homes, and look at the floor plans and see their warranty, and the 2 experience options for property management and more. Getting trapped in the future is as bad as getting trapped in the past. You cannot change the past. The only way to change the future is what you are doing today. If you're pre-qualified, get the report and get started at getricheducation.com/West Florida. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.